Now that yet another October has come and gone, but rather uneventfully, I thought it would be good to have a little bit of a retrospective, to have a look at how the month began and how the month ended. As you would expect, October being October begins with the usual round of hyperbole and nonsense regarding Octobers. And it seemed as if every wood duck in the world popped their head up to offer some form of commentary as to the impending doom that we all faced. The unfortunate thing about this is that the moment you make a prediction public, you are held to that prediction somewhat ruthlessly by people like me. And as we'll see, prediction is largely folly, and I've spoken about this before. Markets are unknowable. That, in part, is the paradox of their enjoyment and the profitability they bring. If we knew what was going to happen tomorrow, next week, next month, next year, there would be no risk premium attached to any form of trading. And if there is no risk premium attached, there is no potential for profitability at all. The two go hand in hand, and you cannot unpick them. So when you enter a market, markets are opaque. And I do understand the desire to remove that opacity. All traders would like a magic crystal ball that tells them what is going to happen to whatever instrument they are trading. So as you can see, October, as usual, got off to its predictable start. And the predictable start to every October is everybody begins to rabbit on about the impending doom that we are about to face. The unfortunate thing about this is that none of this is rooted in data. None of these commentators have looked back at previous Octobers and gone, well, the market really only ended in 2 Octobers. But we've had a countless stream ever since there, where not only has the market not ended, it's actually done quite well. And this is how our October ended, with the market hitting a new high. And if we break this down into returns for the month so far this year, we see something very interesting. October was the second best performing month of this year. Now that does raise the question, is that unexpected? Well, not really when you actually have a look at what markets are actually doing. If we go back and look at this chart, what do we see? We see that recovery from the 2020 COVID blip, as COVID was beginning to run rampant around the world. But from that point on, from that very powerful reversal, what we have is a risk-on signal. Your decision to enter markets is based upon a much broader presumption, and the presumption is that you are what is known as risk-on, which means you are a buyer. Risk-off means that you are out of markets, you have stepped out, or you are a short seller. And so it is that broad macro sort of interpretation that I'm guided by. Markets are quite simple, and I know that I repeat myself over and over again, but when markets are trending up, you are a buyer. When markets are trending down, you are in cash or you are a seller. There is no other interpretation. And as I've said before, markets don't suddenly reverse from a point without telling you. Yes, they have little perturbations and little slippages, and people produce all sorts of nice little metrics saying, well, it's been X number of days since the market corrected 5%, therefore. What they mean by therefore is that they have an emotional investment in this prediction they've just made. So it's very, very important to them that this prediction that they've made comes true, which is why they continue to make them. But this raises the question as to why we have this mismatch between traders' expectations and the actual reality of trading. And there is a profound mismatch. And in part, my feeling is it comes from the information sources that people surround themselves with. There is an old saying in news that simply says, if it bleeds, it leads. And that is that the more breathless your hyperbole, the more extreme, the more oxygen it is given and the more traction it gets. For example, if you watch a nightly news service, if you are foolish to do so, then what you'll see is a veritable torrent of appalling things that have apparently occurred. And that, in turn, is supposed to set the tone for our worldview. But in reality, what a news service that was reflective of what was actually happening would say is simply this. For 99.9999% of the population, nothing happened. Good evening. And that would be it. But that would not in any way conform to this directive of if it bleeds, it leads. And this drives us to the point that the hyperbole drives the narrative. So it is the hyperbole around Octobers and other events in markets that actually drives the narrative that is occurring. It is not the other way around. So when you get this breathless anticipation that is very, very extreme, it will always come to the fore. And this raises the interesting point that if you want to improve both your trading and your mental health, the first thing you do is stop listening to news sources. But there is a natural human habit that people want an opinion that confirms their own existing opinion. We want a story that tells us that our story that we have already formulated internally is correct. We don't go around looking for data that disproves what we think. This is why social media is such a problem, because it creates an echo chamber that continually reinforces what people already think. So if you are looking for dragons everywhere, you will find dragons everywhere. And if you hang around with other people who are looking for dragons everywhere, then every windmill you see will be a dragon. The additional point to this is something I harp on continually. Prediction is folly. Markets are unknowable. Anyone who says that they can predict markets is either mentally ill, has not taken their medication for the day, has a severe concussion, or is simply a liar. In no way is it possible for us to predict the trajectory of markets. We can make very, very broad assumptions, such as my risk on, risk off assumption. We make broad assumptions about the trend of an instrument when we purchase it. But I would say that there is a distinction there in that the purchasing of something is not a prediction. And it's not a prediction because we use risk management. We don't take everything we own and put it all on a single entity. If our predictions were true and correct, that is the way we would approach trading or investing, and we don't. We approach trading through a series of bets that are risk managed. This gives away the notion that we are not actually making a prediction, but rather a bet. But it is interesting to look at what it is within these predictions, within these pronouncements, that are so attractive. So what I've done is I've grabbed one of the earlier ones and I've highlighted a few pieces because there's some little subtle psychological tricks in here that I would like to draw out. The first is this notion of a 25-year market vet. This is an appeal to authority. This is an appeal to experience. I have been around for so long, therefore my predictions carry weight. This is very, very much a classical sort of approach within formulating an argument. And in many ways it is a logical fallacy, but it is one that's used all the time. We then have this notion that this 25-year veteran has some magic tool that pulls apart this sort of veil of uncertainty. We then have a quantification of this prediction. I would call this spurious accuracy. This is simply, to be blunt, a figure that they've pulled out their arse, that they've simply made up. And we have this notion that this is all being shared with you. So you are part of this sort of coterie of knowledge. And if we think about this within the larger context of what's been happening over the past, let's say 2 years with COVID, one of the things that COVID has brought to the fore is the notion of conspiracy theories. Conspiracy theories were designed to make stupid people feel smart. But at the very, very heart of a conspiracy theory is this notion of hidden knowledge. Knowledge that they have somehow found because the truth is hidden from people. That broad psychological framework is also applied in this sort of thing. We have someone here who is a veteran of markets. They've discovered something secret. They're going to share it with you. These are all somewhat very, very careful ploys designed to prey upon the way humans think, upon the way we do things. Because for humans, narrative is everything. The story is everything. And if the story conforms to our worldview or our bias, then it is given enormous weight because it simply supports what we already think. The problem with this is it creates a narrative fallacy. It stops us from looking at data. So when we would see one of these predictions, instead of looking at a chart for, say, the All Ordinaries, the S&P 500, whatever, and simply saying, well, the trend is up, I have risk management in place, I stay long, you begin to think that, well, yes, markets do crash, they always seem to crash in October, but they don't actually, you just haven't taken the time to look at the data. And you won't take time to look at the data because the data is an anathema to your preconception. And your preconception is that dragons are everywhere. And so anyone who tells you that there are dragons everywhere is naturally correct. If someone simply comes along and tells you it's a windmill, then that doesn't conform to your worldview. But this does raise the interesting question of how you should view markets, or rather how I view markets. And it's quite simple. I view markets like I view surfing. It is impossible to predict when the next big wave will come. So sometimes you sit out there all day in the cold, worrying about whatever it was that brushed your foot. Some days are very good, some days are very bad. Some days are the sort you write home about, and some days you're just driven into the sand at the bottom of the ocean and you think, well, that was a complete waste of a day. I think I'll just go and sit in the pub and get warm and lick my wounds. But at no point is anything about the day predictable, nor can it ever be predictable in any sort of micro sense. So in trading, you have to accept that nothing is predictable. So that when people begin to bang on about a 60% crash coming, they're simply making it up. They are simply guessing. And this leads us to the point, do you wish to base your trading or investing upon someone else's guesses or your own sort of systematic approach?